Hey there, knowledge seekers. Welcome back to the Deep Dives, your ultimate shortcut to being brilliantly well-informed. Today, we're diving deep into something that uh, really touches every single product you buy, every service you use, and pretty much every business decision ever made. We are talking about the world of cost accounting. Now, hold on. Before you mentally check out, hear us out. This isn't just about spreadsheets and numbers. No, it's really about understanding the secret language of business, efficiency, and, well, making money.
Absolutely. Think of our mission today as pulling back the curtain on these core ideas from the source material you shared. We're going to demystify what can seem like really complex financial jargon. We'll turn it into clear, actionable insights, basically uncovering the hidden logic that dictates how much things really cost to make and sell, and, what that actually means for a company's bottom line. Get ready for some genuine aha moments, I think.
All right, sounds good. Let's unpack this crucial foundation then. What is cost accounting actually trying to achieve at its, most basic level?
At its core, cost accounting is really all about identifying something called cost objects.
Hmm.
These are literally the things a business wants to measure the cost of. It could be anything, really. A specific product, maybe an entire line of products, a department, a customer, even a particular project. The key is, if a manager needs to make a decision about it, they need to know its cost. Simple as that.
Okay, so if I'm a company, say making chairs, how do I figure out what costs go into making that chair versus like the cost of running the front office?
That's where two fundamental categories come in: product costs and period costs. Product costs are, well, all the expenses directly tied to actually manufacturing a product. The chair, in your example, think of them as part of the product itself. So initially, they're recorded as inventory on the balance sheet, like an asset the company owns. This typically includes your direct materials, the wood, the fabric, direct labor, the people building the chair, and what's known as manufacturing overhead. We'll get more into that. On the flip side, you have period costs. These are non-manufacturing expenses, so costs related to selling the product, sales commissions, advertising, or running the general operations of the company, office rent, administrative salaries. And unlike product costs, these are expensed immediately in the period they happen. They hit the income statement right away.
Okay, that distinction sounds pretty technical, maybe a bit dry. But why is it so important for a business? Like beyond just following the accounting rules, what's the strategic impact here?
Oh, it's absolutely foundational. Misclassifying these costs can drastically, and I mean drastically, warp a company's financial picture. Imagine if you accidentally treat a period cost, like maybe a big advertising campaign cost, as a product cost. You'd overstate your inventory value on the balance sheet, and you'd delay recognizing that expense on the income statement. This can make your profits look artificially high in the short term, which, gives management a really misleading view of how things are actually going.
Ah, okay. So it makes you look better than you are.
Potentially.
Exactly. And conversely, getting product costing right is essential for setting competitive prices. How can you price something if you don't know what it costs? It helps you make decisions about which product lines are actually profitable, and it helps you understand where you can be more efficient. It really is the bedrock for knowing if you're making money and where you can improve.
That makes so much sense. It's not just about ticking boxes for the accountants. It's about seeing the true financial health, the real picture. So once we know what we're trying to cost, the cost object, how do we actually trace all the different expenses back to it?
Right. So costs are primarily traced as either direct costs or indirect costs.
Hmm.
A direct cost is one that can be easily and specifically linked or traced to a particular cost object without a lot of extra work or, fuzzy math. It directly benefits that single item.
Okay, like what?
For instance, direct raw materials. These are the actual physical components that go into a product,
Right.
like the wood for that chair we talked about, or the semiconductor chip in a phone. And this also includes related costs like the freight, the shipping cost to get those materials to your factory. Then there's direct labor. This is the cost of the actual hands-on work that transforms those materials into the finished product. Importantly, this includes not just the time they're actively working, but also expected downtime like breaks or the time it takes to set up machinery for that specific product. I always find real-world examples make these concepts click much better. The source material mentioned Spud Furnishings, Inc. and their custom couches. How do direct costs apply there?
Yeah, that's a great example. For Spud Furnishings, the specific type of fabric or leather used for one particular custom couch order is clearly a direct material. You can easily trace that exact roll of fabric to that specific couch, no question. And similarly, the time spent by the upholsterer physically building that specific couch, that's direct labor. The connection is unmistakable.
Got it. Clear link.
Exactly. Now, indirect costs, which, as I mentioned, are also called overhead or sometimes manufacturing overhead, these are the trickier ones. They generally benefit multiple products or activities, so they aren't easily traced back to just one single item. They're part of the overall cost of running the manufacturing operation.
So things that are necessary but not for one specific couch.
Precisely. This includes things like indirect materials. These are necessary for the factory, but they don't become part of the final product itself. Think about cleaning supplies for the factory floor at Spuds, or small replacement parts for the general machinery, or maybe the oil used to lubricate the sewing machines. Then you have indirect labor. This covers the cost of workers who support the whole manufacturing process, but don't work directly on any one specific product or job. Like the forklift drivers moving materials around the Spud warehouse, the maintenance crew fixing machines, the shift supervisors overseeing everyone, or even the janitorial staff cleaning the production area.
Okay, so materials and labor can be indirect too. What else falls into this overhead bucket?
Yeah, beyond materials and labor, there are lots of other indirect costs. Things like the depreciation expense on the factory building itself and on the big manufacturing machinery, the rent for the production warehouse if they don't own it, property taxes on the factory, insurance for the manufacturing facility, utility bills, electricity, water, gas for the Spud furnishings plant, all essential for production, yes, but you can't really pinpoint how much electricity one specific couch used, right?
Right, that makes sense. It's spread across everything. So we have all these different types of costs floating around. Do companies ever group them together in specific ways to get a clearer picture of, I don't know, different aspects of production?
Yes, absolutely. That's a common practice. Two important groupings you often hear about are prime cost and conversion cost. Prime cost is simply the sum of direct labor plus direct material. These are seen as the most sort of obvious costs directly involved in making something.
About the correct stuff.
Exactly. Then conversion cost is direct labor plus manufacturing overhead. This represents the cost incurred to convert the raw materials into a finished product, the labor and the factory support needed for that transformation.
Okay, so prime is the inputs, conversion is the transformation.
You got it. These groupings just help managers analyze different cost drivers in the production process, and because those indirect costs, the overhead, aren't directly traceable, they have to be allocated, assigned somehow. They use things called cost drivers, which are also sometimes called allocation bases. These drivers are chosen because they have, hopefully, a strong logical relationship to how those indirect costs are actually incurred. In, let's say, more traditional costing systems, all the indirect costs might just get lumped together into one single overhead bucket. And then they're allocated using one broad driver, like maybe the total direct labor hours worked in the factory.
Okay, like a simple average based on labor time. That makes sense for a basic approach. Now, moving beyond where costs come from, how do they behave? Do they always stay the same amount, or do they change depending on how much stuff you produce? This seems like it would have huge implications for a business.
This is a fantastic question, and you're absolutely right, it's critical for decision making. Costs can be classified by their behavior as fixed, variable, or sometimes mixed.
Okay, variable first.
Sure. A variable cost changes in total proportionally with the cost driver, usually something like sales volume or production volume. So if you double your production, your total variable costs will roughly double as well. But here's the crucial point. The variable cost per unit remains constant.
Huh. How does that work?
Well, think back to the Spud couch. If the fabric costs, say, $100 for one couch, it still costs $100 for the next couch and the one after that. So the cost per couch is constant at $100. But if you make 10 couches, the total fabric cost is $1,000. Make 20 couches, it's $2,000. Total cost changes, per unit cost is the same.
Got it. Total varies, per unit is constant. So fixed costs must be the opposite.
Exactly. Fixed costs do not change in total within a relevant range, even if your production volume goes up or down. Think of your factory rent. Let's say it's $10,000 a month. It's $10,000 whether you produce 100 couches or 1,000 couches that month. The total is fixed.
Okay, total stays the same.
Right. However, the fixed cost per unit will vary inversely with volume. It actually decreases as production volume increases because that same $10,000 total fixed cost is spread over more units. If you make 100 couches, the rent cost per couch is $100. But if you make 1,000 couches, the rent cost per couch drops to only $10.
That's why higher volume can make things cheaper per item, spreading the fixed costs.
Precisely. That's the concept of economies of scale, partly driven by fixed costs. Depreciation expense on buildings and machinery is typically a fixed cost too, although I should add fixed costs are only fixed within a certain relevant range. If you push production way beyond your current capacity, you might need a whole new factory, and then your fixed rent cost jumps up significantly.
Okay, so fixed isn't forever fixed. And what was the third type? Mixed.
Right, mixed costs, sometimes called semi-variable costs. As the name suggests, they have both fixed and variable components. There's usually a base amount that stays constant regardless of volume, and then there's a proportion that fluctuates with production or activity level.
Like maybe the salesperson's salary. Base pay plus commission?
That could be one example, although that's often considered a selling cost, not a manufacturing cost. A better manufacturing example might be factory electricity. There might be a base charge just to be connected, fixed part, plus a charge based on how many kilowatt hours you actually use, which depends on machine usage, variable part.
Okay, got it. Can you give us an example of how these all play out in a real business? Because this behavior distinction feels like it could really impact strategy. The source mentioned Quality Ornaments, Inc. That sounds like a good case.
Absolutely. Quality Ornaments Inc. makes figurines and ornaments. Let's look at their costs by behavior. Their direct labor and raw materials, the clay, the paint, the artist's time, those are clearly variable costs. More figurines mean more materials and more labor time, changing directly with production.
Okay, variable. Makes sense.
Plant depreciation on their building and maybe the kilns and perhaps basic heating costs for the factory, these are likely fixed costs. They stay pretty constant regardless of how many ornaments they make within their normal operating range.
Right.
Indirect labor could be a mixed cost. Maybe they have supervisors on a fixed annual contract, but they also pay overtime or hire temporary help during peak season based on production hours, which would be variable.
Mixed. Okay.
Electricity used specifically for the production machines, that's probably mostly variable, tied directly to how many hours the machines run. Delivery expenses to ship finished ornaments to customers also variable depending on the number of orders or shipments. And maintenance and repair could be mixed too. They might have a fixed contract for routine workday maintenance, but then pay a variable hourly rate for emergency repairs needed on weekends or holidays, which might fluctuate with production intensity.
That example really brings the nuance to life. It's not always perfectly one or the other. And you mentioned relevant range a few times. Why is that little phrase so important when we talk about fixed and variable costs?
The relevant range is really important. It's the specific operating level or activity range, say, producing between 5,000 and 15,000 ornaments a month, for which our assumptions about a cost's behavior are valid. If Quality Ornaments suddenly decides to produce 50,000 ornaments next month, way outside their normal range, they might need a second factory, new kilns, more supervisors. Suddenly, costs we thought were fixed, like rent or supervisor salaries, might jump up to a whole new level. So outside that relevant range, the assumed cost behavior, fixed or variable, might no longer hold true. It's a key boundary condition for these classifications.
Okay, that's a critical caveat. So given all these different cost types and behaviors, how do companies actually collect all this data and apply it to their products? Are there different accounting systems depending on what kind of company it is or what it produces?
Yes, exactly. There are two primary cost accumulation systems, and the choice between them depends entirely on the nature of the product or service being offered. What are you making?
Okay, what are they?
First, there's job order costing, which people often just call job costing. This method is used when you produce unique, distinct items or batches, things where each unit or project is different or easily identifiable. Think about building a custom house, assembling a specific aircraft for an airline, printing a unique wedding invitation order, or even a consulting firm working on a specific client project. The job itself, the house, the plane order, the invitation batch, the consulting engagement is the central point for collecting all the associated costs.
So like a folder for each specific project.
That's a great analogy. Under job costing, every cost is meticulously tracked and allocated to each specific job as it moves through the production or service process. Companies maintain job cost records or job cost sheets, which are exactly like that folder. They accumulate all the direct materials used, tracked by materials requisitions forms, all the direct labor hours spent, tracked by labor time tickets, plus an allocated share of the manufacturing overhead for that particular job.
Okay, job costing for unique items. What's the alternative?
The second main system is process costing. This is used for mass-produced, homogeneous items products that are essentially identical and flow continuously through production. Think of manufacturing steel, soft drinks, chemicals, gasoline, paper. Things where one unit is basically indistinguishable from the next.
Right, like you wouldn't track the cost of one specific can of cola.
Exactly. It wouldn't make sense, and it would be incredibly costly to even try. Instead, process costing averages costs across a large number of identical items produced during a period. The process usually involves several stages. First, you track the physical flow of units through different production departments, mixing, bottling, packaging, etc. Then you calculate something called equivalent unit output. We need to discuss that. You accumulate all the total costs incurred for each department during the period. Then you calculate average unit costs for each department. And finally, you apply those average costs to the units that were completed and transferred out, and also to the units that are still partially completed and remaining in inventory at the end of the period.
Okay, hold on. Equivalent units. That sounds like a bit of accounting magic. Can you give me a really simple, maybe everyday way to think about this concept, just to make it more intuitive before the technical stuff?
Absolutely. Let's use a baking analogy. Maybe not perfect, but it helps. Imagine you're baking a huge batch of 100 cookies. By the end of the day, you have 80 cookies that are fully baked, cooled, and ready to sell. Done. But you also have 20 cookies still on the baking tray. The dough is mixed, they're shaped, but maybe they're only halfway through the baking time, say 50% complete in terms of the baking process.
Okay, so 80 done, 20 half-baked.
Right, so you don't really have 100 finished cookies worth of effort put in yet, do you? You have the 80 fully completed cookies, plus the equivalent of 10 more fully baked cookies from those 20 partially done ones. 20 cookies, 50% complete equals 10 equivalent units. So in total, you've achieved 90 equivalent units of production in terms of baking effort.
Ah, I see. It converts the incomplete work into the terms of fully completed units.
Precisely. It's crucial for costing when you have work in process inventory at the end of an accounting period, which is almost always the case in continuous production. You need a way to account for the resources used on those partially finished goods.
Okay, that makes more sense. So how do accountants actually calculate these equivalent units? Are there different ways?
Yes, there are two main methods used to calculate equivalent units in process costing. FIFO, which stands for first in, first out, and weighted average. The main difference between them lies in how they account for any work that was already partially completed and sitting in inventory at the beginning of the period.
Okay, so how does FIFO handle that?
Under FIFO, the logic is that you finish the oldest units first. So you calculate the work needed to complete the units that were in beginning inventory. Then you add the units that were both started and completed during the current period. Those are 100% equivalent units for this period's work. And finally, you add the work done on the units started but only partially completed at the end of the period. FIFO focuses on matching current period costs with the work actually done during the current period. It keeps beginning inventory costs separate.
Okay, FIFO seems logical. First in, first out. What about weighted average?
Weighted average is generally simpler. It doesn't separate beginning inventory work from current period work. It essentially blends or averages the costs from the beginning work in process inventory with the costs incurred during the current period. For calculating equivalent units under weighted average, you just take the total units completed and transferred out during the period. Those are always 100% equivalent for this purpose, and add the equivalent units of work done on the ending work in process inventory. It averages everything together.
So weighted average kind of smooths things out, mixes old and new costs, while FIFO keeps them separate.
That's a good way to think about it. They'll often give slightly different unit costs, especially if costs are changing significantly from one period to the next. The choice depends on the company's needs and philosophy.
Okay. Now, in any production process, things don't always go perfectly. What about stuff that gets ruined or wasted, spoilage? How do accountants handle that financially? Does it just disappear?
No, it definitely doesn't disappear. Spoilage, or sometimes shrinkage, is a very important consideration, and how it's classified has big implications for costs. It's typically classified as either normal spoilage or abnormal spoilage.
Normal versus abnormal. What's the difference?
Normal spoilage is the spoilage that occurs under regular, efficient operating conditions. It's basically an expected, unavoidable part of the manufacturing process itself. Think of a certain small percentage of glass bottles breaking during filling, or some dough sticking to the machines in a bakery. It just happens, even when things are running well.
Okay, unavoidable waste.
Right. And because it's expected, the cost of this normal spoilage is actually built into the standard cost of the good products you successfully manufacture. It gets capitalized as part of the inventory cost. The effect is that the per unit cost of the good units automatically increases slightly because the total production costs, including the cost of the normal spoilage, are spread over fewer sellable units.
So the good units absorb the cost of the normally spoiled ones. What about abnormal spoilage then?
Abnormal spoilage is spoilage that should not occur under normal, efficient operating conditions. This is usually the result of something going wrong, a significant error, a major machine malfunction, unusual inefficiency, maybe a bad batch of materials, something preventable.
Okay, so this is waste you don't expect.
Exactly, and because it's not expected and should be preventable, its cost is not added to the cost of the good products. Instead, the cost of abnormal spoilage is typically treated as a loss and expensed separately on the income statement in the period it occurs. It's usually listed as a period expense, highlighting that it's a loss due to unusual circumstances, not part of the standard product cost.
That makes sense. You want to flag those unusual losses separately. Let's tie that back to our listener with that fresh baked company example making pies. This normal versus abnormal distinction must be crucial for figuring out their actual pie cost and profitability.
Excellent idea, really clarifies things. So Fresh Baked Company produced 20,000 pies. Their direct ingredients, flour, fruit, etc., their baking labor, and their regular plant production overhead all contribute to their inventory costs, the cost of the pies. Importantly, their normal spoilage of $400, the cost of pies that are expected to be slightly burnt or damaged during normal baking is also added to those inventory costs. So their total inventory cost becomes, say, $80,400. This makes the per unit cost for each good pie $4.02. $80,400 divided by the 20,000 good pies produced.
Okay, so normal spoilage is part of the $4.02 cost per good pie.
Correct. However, their sales and marketing expenses, their general and administrative office expenses, and critically, their abnormal spoilage of $200, maybe a whole rack of pies got ruined because someone set the oven wrong, these are all treated as period expenses. They get expensed immediately, hitting the income statement directly as losses or operating expenses for that period. They are not added to the $4.02 cost of the good pies sitting in inventory.
Wow. So that distinction directly impacts the reported profit for the period and the value of their inventory on the balance sheet. And it flags operational issues.
Precisely. It highlights operational problems, abnormal spoilage that management needs to address, separate from the inherent unavoidable waste, normal spoilage of the process.
Okay, this is starting to paint a really detailed picture. But that traditional costing approach you mentioned earlier, with just one single overhead pool allocated by something simple like labor hours, that sounds a bit like a blunt instrument, especially for complex businesses with lots of different activities. Are there more precise ways to assign those tricky indirect costs?
There absolutely are, and you've hit on the exact reason why more sophisticated methods were developed. This brings us to activity-based costing, or ABC. Unlike traditional systems that often use just one broad, usually volume-based cost driver like direct labor hours or machine hours for all overhead, ABC operates on a fundamentally different assumption. It assumes that products don't consume costs directly. Rather, products consume activities, and it's those activities that consume resources, which have costs.
Okay, products consume activities, activities consume resources.
Exactly. So ABC aims to allocate indirect costs based on a product-specific demand for those resource-consuming activities. It's a much more focused, granular, and potentially more accurate approach designed to give a truer picture of what really drives costs, especially overhead.
So it drills down deeper than just labor hours.
Much deeper. ABC starts by identifying various distinct activities performed within the firm, things like handling materials, setting up machines for production runs, processing purchase orders, performing quality inspections, or maybe redesigning products. Then it identifies the resources, like employee time, machine capacity, supplies, used for those specific activities. And crucially, it identifies the cost drivers that truly cause the costs of those activities to be incurred. These drivers might be volume-based for some activities, but often they're based on complexity, number of setups, number of orders, etc. Costs are then grouped into activity centers or cost pools related to these activities. And then those costs are applied to the cost objects, like products, based on exactly how much each product uses those specific activities, measured by the activity's cost driver.
Okay. Can you give an example, like the Hope Hospital one in the source?
Yeah, the hospital example is good. Think about Hope Hospital's surgical unit. The surgical unit itself could be considered an activity center. The specific activities within that center might include things like preparing an operating room before surgery, the surgical procedure itself, post-operative care within the unit. The resources consumed are the surgeons' and nurses' time, the operating room facilities, sterile supplies, specialized equipment. The resource drivers, linking resources to activities, might be things like square footage for facility costs or staff hours for labor costs. And then the activity drivers used to assign the activity costs to patients, the cost objects, could be things like the number of surgical procedures performed, the complexity or duration of each surgery, or perhaps the number of patient admissions to the unit. It tries to find the real cause and effect.
Okay, that sounds much more detailed. So how does ABC actually work in practice? Like step by step, how do you implement it?
Right. The basic operation usually involves about 6 key steps. 1. First, you identify the key cost drivers and the relevant activity centers within the business, like machine setup or customer order processing. 2. Then you accumulate the overhead costs into many small, distinct cost pools, one for each major activity center. 3. Where possible, you trace any indirect costs that you can directly link right to the specific activity centers they belong to. 4. Next comes the main allocation. You allocate the remaining indirect costs from those activity center cost pools to the actual products or services, the cost objects, using the most appropriate activity cost driver for each pool. So machine setup costs might be allocated based on the number of setups per product, not labor hours.
So different rates for different activities.
Exactly. Step 5 is calculating that rate. You divide the total costs assigned to an activity center by the total level of activity driver for that center, e.g. total setup costs divided by total setup hours, to get an application rate per activity. And finally, step 6. You cost the product by multiplying its actual demand for each activity center's resources. You're going to be how many setup hours this product used by that specific activities rate and summing it all up.
Okay, that definitely sounds more involved than the traditional method. Let's see how this actually plays out. Does it really change how we see product costs compared to the old way? The Iowa products example in the source material with the cans and bottles seems perfect for illustrating this.
It absolutely does, and the Iowa products case is a classic illustration of why ABC can be so revealing. It often leads to dramatically different cost pictures. So Iowa products makes simple cans and more complex bottles. Under a traditional costing system, let's say they allocated all their factory overhead based purely on direct labor hours. Because maybe both products take roughly the same amount of direct labor, they might find that both products appear to have the exact same overhead cost per unit. The source says $4.80 per can and $4.80 per bottle.
Okay, looks like they cost the same from an overhead perspective.
Right. That happens because the traditional overhead allocation using a single volume-based driver like labor hours essentially peanut butters the overhead costs evenly across all products based on volume. But now let's apply ABC. We break down that same total overhead into multiple specific activity centers. Maybe material handling driven by number of moves, production orders driven by number of orders, product redesign driven by number of engineering hours, and plant utilities driven by machine hours.
Okay, much more detail. What happens then?
When we allocate the costs from these pools based on the specific activities each product actually demands, the picture changes completely. The analysis shows the cost of cans decreases significantly, maybe dropping from that $4.80 down to $3.79 per can. But the cost of bottles increases dramatically, jumping from $4.80 all the way up to 8.167 cents per bottle.
Wow, that is a massive difference.
Oh.
They went from looking equal to one being more than twice as expensive in overhead. What caused such a huge shift?
That's the core aha moment of ABC right there.
Yeah.
It turns out that the bottles required a huge amount of the very expensive product redesign activity, lots of engineering hours maybe. They were complex. The simple cans barely used that resource at all. Traditional costing, by spreading that expensive redesign cost evenly based just on direct labor hours, effectively undercosted the resource-hungry bottles and overcosted the relatively simple cans.
So the traditional method was hiding the true cost drivers.
Exactly. ABC removes that distortion. It assigns costs based on the actual consumption of those specific, sometimes expensive activities and resources. This gives Iowa Products Management a far, far more accurate view of their true product profitability. And that accuracy can lead to entirely different strategic decisions about pricing, product mix, process improvements. Maybe they should focus more on cans, or charge way more for bottles, or find ways to make bottle redesign cheaper.
That's powerful stuff. Knowing your true costs seems essential.
It really is. And beyond just costing products, ABC principles can also be really useful for something called service cost allocation. This is all about how companies allocate costs from their internal support departments, think departments like IT, human resources, accounting, maintenance, to the departments that actually use their services, which are often the production or operational departments. And eventually, those allocated costs need to find their way to the final products or services.
Right, because the cost of HR or IT supports the production line somehow. How do they allocate those?
There are a few common methods. The direct method is probably the most widely used, mainly because it's the least complex. With the direct method, each service department's total costs are allocated directly to the production or user departments only. It completely ignores any services that one service department might provide to another service department.
So IT costs go straight to production A and production B. HR costs go straight to production A and B. And we ignore if IT uses HR.
Exactly. Simple, but potentially inaccurate if service departments support each other significantly. The step-down method, or sequential allocation method, is a bit more sophisticated and tries to address that limitation partially. Here, service department costs are allocated sequentially to other service departments as well as to production departments. However, it's typically a one-way street. You pick an order for allocating the service departments, often starting with the one that provides the most service to others. Once a service department's costs have been allocated out, no costs are allocated back into it from departments further down the sequence.
Okay, so it acknowledges some inter-service support, but not reciprocal support. Can you quickly walk through how these two methods differ with an example, like the Remington Company one with their IS and HR departments supporting divisions A and B?
Certainly. Let's imagine Remington Company has an information systems IS department and a human resources HR department, both supporting two production divisions, Division A and Division B. Under the direct method, let's say IS costs are allocated based on computing hours used by A and B, and HR costs are allocated based on the number of employees in A and B. So IS costs go only to Division A and Division B based on their direct usage. HR costs go only to Division A and Division B based on their employee count. The fact that the IS department also has employees and uses HR services, like for hiring, payroll, performance appraisals for IS staff, is completely ignored in this method.
Okay, direct ignores the IS uses HR link. What about step down?
Under the step-down method, we first need to decide which service department to allocate first. Let's say we allocate HR first, perhaps because it provides service to IS, but IS doesn't provide much service back to HR. So first we'd allocate HR's total costs to IS, Division A, and Division B based on their respective drivers, for example, number of employees. Now the IS department has its original costs plus the chunk of HR costs just allocated to it. In the second step, we allocate the new total IS cost pool, original IS costs plus allocated HR costs, only to the remaining departments, Division A and Division B, based on their computing hours. No cost goes back to HR because its costs have already been fully allocated out.
Ah, I see. So the final cost ending up in Division A and B is different because IS first receives some of the HR's costs before passing its total costs along.
Precisely. The step-down method provides a more comprehensive, though still not perfectly reciprocal, view of interdepartmental service usage compared to the direct method. It changes the final cost allocations to the production divisions. There's also a reciprocal method, which is even more complex and accurate, but step-down is a common improvement over direct.
This makes me think about other tricky situations. What happens in industries where one single production process yields multiple different products at the exact same time? Like, how do you possibly figure out the cost of each distinct product that emerges together?
You've landed on the challenge of joint product costing and byproduct costing. This area deals specifically with how to allocate those common costs incurred in a single process among several different final products that emerge simultaneously from that process.
Can you give an example?
The most vivid, classic example often used to explain this is the meatpacking industry. You start with a single common input, let's say a steer or a hog. From processing that single animal, you inevitably produce many distinct final products simultaneously. You get various cuts of meat, steaks, roasts, ground beef. Maybe some parts go into pet food, hides might be used for leather. Other parts might yield basic ingredients for things like gelatin or even glue.
Right. One input, many outputs.
Exactly. All these products share the initial cost of acquiring and processing that animal up to a certain point. Each of these distinct final products must be assigned a portion of that shared cost, but they all came from that single initial process. How do you split the bill?
Okay, so let's define some key terms here. What's a joint product versus a byproduct?
Good idea. Joint products are two or more products that are generated from a common input and production process, and they are usually considered significant in terms of their sales value relative to each other. The different cuts of meat from the steer would likely be joint products. Byproducts, on the other hand, are products that also emerge from that same process but have a relatively minor sales value compared to the main joint products. They are often seen as incidental outputs. Maybe the bones sold for gelatin in the meat packing example could be a byproduct, depending on their value.
Okay, main products versus minor incidental ones. What's the split-off point?
The split-off point is that crucial moment or stage in the shared production process where the joint products and any byproducts become separately identifiable as individual distinct items. Before this point, they're all mixed together in the process. After this point, they go their separate ways. Joint product costs, or just joint costs, are all the costs incurred up to this split-off point, the cost of the common input and the shared processing. And separable costs are any additional costs incurred after the split-off point to process each individual product further, maybe to make it ready for sale. For example, the cost of packaging specific cuts of meat after they've been separated.
Okay, got the terms. So the big question remains, how do we decide how to split those joint costs, the costs incurred before the split-off point among the different joint products?
Right, that's the core allocation problem. There are a few main methods companies use. One straightforward method is allocation by unit volume relationships, or sometimes called the physical units method. You simply allocate the total joint costs proportionally based on some physical measure of the volume of each product produced at the split-off point, like gallons, pounds, board feet, or number of units. The source uses simple manufacturing company making product A, 10,000 gallons, and product B, 20,000 gallons, from a total joint cost of $10,000. Using this method, product A, which is 1/3 of the total volume, would get allocated 1/3 of the joint costs, $3,333, and product B, 2/3 of the volume, would get 2/3, $6,667, purely based on physical output quantity.
Simple enough. But does volume always reflect value? Maybe 1 gallon is worth way more than another.
That's the main criticism of the physical units method. It ignores the economic value of the products. That's why another very common and often preferred set of methods uses relative sales values, or net realizable values. These approaches are generally favored because they allocate costs in proportion to the product's ability to generate revenue, which is usually seen as more logical and relevant for decision making.
Okay, how does that work?
Well, if sales price quotations are available at the split-off point, meaning you could actually sell the products right as they become separate, you simply allocate the joint costs based on the relative total sales value of each product at that exact point. The Brown Company example shows this. They produce products A and B. Let's say right at split-off, product A has a total potential sales value of $2,000 and product B has $6,000. Their total joint costs are $1,000. Product A represents 25% of the total sales value, 2K, 8K total, so it gets 25% of the joint costs, which is $250. Product B is 75% of the value, so it gets $750. Costs follow value.
Okay, that seems more economically rational. But what if you can't sell them right at split-off? What if they need more work?
Great question. If sales values are not available at split-off, perhaps because the products require further processing before they can be sold, you have to estimate a value at that point. You do this using the net realizable value NRV method. You take the final selling price of each product after further processing, and then you subtract any identifiable separable costs incurred after the split-off point to get that product ready for sale. This gives you an estimated or net realizable value back at the split-off point.
So final price minus the cost to finish it up.
Exactly. The Smith Company example illustrates this. They make products F and G from a joint process with $30,000 in joint costs. Let's say product F sells for 25 unit after unit in separable processing costs, and product G sells for 50 unit after 10 unit in separable costs. We'd calculate the NRV per unit for each. F is $24, $25, G is $40, $50, $10. Then we multiply by the number of units produced to get the total NRV for F and G. Maybe F's total NRV comes out to $24,000 and G's is $16,000. The total NRV is $40,000. F represents 60% of that total NRV, 40K, so it gets 60% of the $30,000 joint costs, which is $18,000. G gets the remaining 40%, or $12,000.
Okay, so even if they need more work, you allocate based on their estimated value back when they first separated. That makes sense. What about those byproducts, the minor value items? How are they treated?
Right. Byproducts, being outputs of relatively minor value, are handled differently. Their value usually isn't significant enough to warrant the complexity of joint cost allocation. So typically, any revenue generated from selling the byproduct is treated in one of two ways. One option is to treat the byproduct revenue as a reduction to the common costs that are being allocated to the main joint products. So selling the byproduct effectively makes the main product seem a little cheaper to produce. The other common option is to simply treat the byproduct revenue as miscellaneous income, or other revenue, on the income statement when it's sold. It doesn't affect the costing of the main products directly.
So it's either an offset to the main cost or just extra income on the side. This seems like a fascinating choice companies have to make, deciding if something is a main joint product or just a minor byproduct. Is there a historical example that really drives home how this decision can change based on market value?
Absolutely, and the source gives a fantastic classic example: gasoline. Believe it or not, before the invention and widespread adoption of the automobile, gasoline, which was an unavoidable output of refining crude oil to get kerosene, which was valuable for lamps, had virtually no value. It was literally considered a waste product, a nuisance scrap material that refiners often just dumped.
Wow, really, gasoline was junk.
Hard to imagine now, right? But then, cars came along, and suddenly demand for this previously worthless gasoline soared exponentially. Initially, as it gained some value, refiners started accounting for it as a byproduct. Its revenue was just a small offset against the cost of making kerosene. But as its value and demand continued to skyrocket, eventually surpassing kerosene, it became recognized and priced as a primary joint product of the oil refining process, allocated a significant share of the joint refining costs.
That's incredible. It perfectly shows how the accounting classification byproduct versus joint product isn't just some arbitrary accounting rule. It's a practical, strategic decision that directly reflects market demand and relative economic value. What's junk one decade is black gold the next.
Exactly. It's driven by the economics of the situation.
So wrapping this all up, what does all of this mean for us, the listener? Maybe the next time we're looking at a product on a shelf or thinking about a business we interact with.
We've really peeled back a lot of layers of cost accounting today. We went from identifying what exactly you're trying to cost to breaking down all the different expenses by whether they're direct or indirect, how they behave like fixed or variable, understanding the different systems like job costing versus process costing, getting into equivalent units and spoilage, and even figuring out advanced techniques like activity-based costing and how to handle multiple products emerging from a single process.
Ooh.
Indeed, it was quite a journey through the mechanics. But I think this deep dive really reveals that cost accounting is far, far more than just a dry financial record-keeping exercise. It's truly a powerful strategic tool. It gives businesses the critical insights they need to price their products effectively, to accurately evaluate which products or services are actually profitable, to find hidden inefficiencies in their operations, and ultimately just to make smarter, more informed decisions every single day. It really transforms that raw financial data into a practical roadmap for better management and ultimately for competitive advantage.
What a fascinating look under the hood of business costs. So here's something to chew on. The next time you look at the price tag of an item anything, a cup of coffee, a piece of software, that couch from Spuds, consider this provocative thought. How do you think the principles we've discussed today, like direct versus indirect costs, fixed versus variable expenses, maybe even the complexity revealed by activity-based costing, how might all that have influenced the final price you see? And what does that price perhaps tell you about the strategic choices, the efficiencies, or maybe the challenges the company faced in bringing that specific product to you? What costs might have been the hardest for them to figure out or control? A great question to ponder. Thanks for joining us on this deep dive into the world of cost accounting. Until next time, keep digging for knowledge.